All right, folks, here's another question from Chapter 1. Remember to write this one down. This is Part 4. Remember to write this down because you're going to have to put it in on your quiz. According to Professor Cohen, which number on the statement of cash flows needs to be positive for a successful company? Okay? Make sure you write this one down, and this way you'll be all set to go when it comes time for that quiz. All right, folks. So the next thing we're going to talk about, if you take a look up here, is this idea of notes. Notes to the financial statement. Now, when they say notes to the financial statement, what they mean is that at the end of the financial statement, they go through and they talk about how they do their accounting. In other words, what in accounting you have some choices to make, like how to depreciate certain things. So there is some flexibility in the rules, and what those notes do, those notes explain how they're doing it. Okay, and that's important for the people that are looking at the financial statement. It's important for them to understand what's going on. So that's what they mean by notes. Okay, all right. All right, next thing, and this, to be honest with you, when I was a student like you, this is one thing I didn't get right away, actually, till I almost graduated. But it's important if you understand it, it really helps you get the idea. So if you take a look here, we're starting here, we got the income statement right here, okay? So we got our income statement, and when we come all the way down to here, right, we know at the bottom line on the income statement, I'm going to change this over to my pen. Bottom line on the income statement, we wind up with a number, right? Okay. So right here, you could see right here, we made $2,000, okay? Now, this $2,000, it goes over to this statement of retained earnings. Again, statement of retained earnings, company name for the month ended, again, a certain period. Notice we started with 0. We added that net income right here, right, 2,000. Then we subtracted the dividends. And remember, dividends are non-expense. They subtract them here. So now our new retained earnings is $1,000. So on the next statement, for the next month, instead of that 0 up there, we'd be starting with 1,000. So you see how those two are connected? Okay. Now, the statement of retained earnings, the one we were just looking at, see that $1,000 right there? That goes over here to the balance sheet. So you see, we started at the income statement, we went to the statement of retained earnings, and then the retained earnings shows up on the balance sheet right here. And again, balance sheet, we have all of our assets here. By the way, when you see receivables means somebody owes you money. Payable means you owe. Okay? So one is incoming, the top one is incoming, and this one is outgoing. Okay? Meaning you have to pay somebody, right? Then we separate them into short-term and long-term. Then we have stockholders' equity. This common stock, that was the $10,000 from selling the original stock. Then we have this retained earnings of 1,000, totals 11. You add this 25, you add this 11, and you get 36. And notice it matches. So notice we got 36 right here is equal to liabilities of 25 plus stockholders' equity of 11. Okay? See? Not too bad. By the way, that's how they all work together. Now, finally, we have one more, right? When we go to the statement of cash flows, right? So we started out, we wound up with $13,000. Notice that matches up with the balance sheet. And remember, on the balance sheet here, it's at a certain day and time, certain point in time. Okay, that's the only one. Everything else is for a period of time. Okay, so all you got to do is remember, balance sheet, date and time, everything else, period of time. Okay, and again, notice how they all tie together. So the good news is, well, now you understand they all tie together. The bad news is that if you make a mistake on the income statement and you don't catch it, it's going to go all the way through. Okay, all right. Anyway, hopefully you understood that. Watch this a few times if you need to. Okay. Next item we're going to take a look at is how are they used by decision makers? So remember, the whole point of doing this is to help people make decisions, okay? By the way, in the United States, it's all about our financial markets. That's how businesses grow. Without the money from stock and without people investing, businesses wouldn't have the funds to grow. They might be able to borrow some from the bank, but the banks can't do it all, right? That's why they have stock. So let's see how they use it, okay? All right, so the first, let's go down here. Let's just punch all these in, all right? So for creditors, these are people that they lend money, like banks and stuff. Here's the first one. It's a company generating enough cash to pay what it owes. Where would you find that? Right here. Statement of cash flows, right? So statement of cash flows would tell you, hey, are you generating enough money to pay your bills, right? Does the company have enough assets to cover its liabilities? Where would you find assets and where would you find liabilities? You'd find that on the balance sheet, okay? So what is the immediate return through dividends on my contributions? Statement of retained earnings. Remember, that shows you how much money the company retained, okay? So if you want to see what was paid with dividends, that's where you'd find out. Then the next one says, this is for investors now, what is the long-term return through stock price increase? And you'd find that information on the income statement. So you would be able to see if they're making a lot of income, you'd be able to calculate what you think the stock price should be, okay? So again, pretty important stuff, okay? Now, some other factors that contribute to useful financial information. So when you make these reports, we have to have certain rules, certain things, certain guidelines. You can't just let people make it up willy-nilly, right? Because otherwise, people will just make things up. So let's take a look. So in order for the information to be useful, okay, in order for the information to be useful, which is the whole idea, the information must be relevant, and it says faithful representation, which really means true. In other words, you have to be honest about what you're saying, and it has to be relevant. So, for example, whether or not how tall you are, okay, that may be a true statement. I say, well, all my students are above 5 foot tall, right? That may be true, but is it relevant? Is you being about 5 foot tall, is that going to make you a good student? So you see, the information could be true, but if it's not relevant, it doesn't matter. And then some other things regarding this. Is it timely? Do you get it in enough time to make a decision? Can you verify it? You know, like how tall are students? Yeah, we can measure you all. But see, the problem is it wouldn't be relevant. It would be verifiable, but not relevant. Then comparable. What they mean by that is when you go and do your financial statements, like I mentioned, you actually have some choices to make on how to do certain things. You can't keep changing back and forth because it makes them not be comparable. It's like apples and oranges if you were doing that, right? And then the other idea is they have to be understandable. Usually in accounting, I'm also a fraud examiner. If you ever come across a transaction, you're like, why in the world would they do it that way? If you can't figure out why that is, chances are there's something up with that transaction, okay? All right, so there you go. That's the main goal, providing useful financial information, okay? Now accounting standards. So in the United States, FASB actually creates the rules, and US GAAP are the rules we follow. Now, in the rest of the world, basically, these international financial reporting standards. By the way, these are getting closer and closer, right? But way more use this than US GAAP, okay? We have our own rules here in the United States, okay? There's some countries that follow it, but the majority of them use the international standards. Again, they're getting pretty close, but there are some significant differences. And if you continue to study on in accounting, you'll learn more about those differences and why they occur, okay? This last piece here, they're talking about ethical dilemma. What should you do? So anyway, a big problem with accounting, you're talking about numbers, you're talking about people's livelihood. Identify who will be affected by the situation. Who's it going to impact, right? Alternative courses of action, and then choose the alternative that's the most ethical. By the way, if a lot of times people want accountants and financial people to do unethical things, you can't do it. It'll cost you your livelihood and everything else. The one thing, ethics are imperative. Okay? All right. That's it for the lecture. We're going to come back. We're going to do some of these problems. We're going to do some walkthrough problems so that you understand what's going on. You got to make sure you watch those too and take notes while you're doing it. All right. Be back in just a minute.